The broadcast is now starting. All attendees are in listen-only mode.
Well, good morning, everybody. Thank you very much for taking time out of your schedules to join us for day one of our Index Universal Life Boot Camp series. We've partnered with North American company who has one of the best Index Universal Life portfolios in the industry. It's kind of hard to talk about life insurance without seeing where the direction is going with life insurance. And life insurance is going to the ways of Index Universal Life. Sales are up 30, 40, 50% with carriers when it comes to Index Universal Life sales. It's something that clients are looking for, and this is something that some agents they're comfortable with it, and some agents are not. My name is Matt Alina. I'm one of the agent support specialists here at URL, and again, thank you very much for joining us. To kind of break down what we're going to be doing here, and I know your time is valuable, and we're going to give you some of the information here in snippets, if you will, just because there is so much information that we want you to be comfortable, and we want you to be able to have a good conversation with clients and realize that there is money to be made here while you're helping your clients. So we're going to be doing 5 weeks of training. And week number 1, which is this week, we're kicking it off with the Index Universal Life mechanics, how they work. It's really just going to be the nuts and bolts of the products. Next week, same time, we're going to be discussing how insurance companies cover index credits. And so you can have a conversation with your client about that. How do my cash values increase? And how do I take loans out of the policies? These are going to be things we're going to be talking about in the coming weeks. Week number 3, we're going to be discussing compelling product features with North American company. Some product features that no other insurance company offers, and it's going to be kind of packaged really nice within their Index Universal Life portfolio. We're also going to show you in week number 4 how to prepare effective policy illustrations. How do you put you ahead of the competition? How do you get that client to sign on the dotted line and be comfortable with what they're purchasing? We're going to show you how to do that. And last but certainly not least, how do you sell it? How do you approach somebody about Index Universal Life? How do you prepare those illustrations? And again, how do you put their name to the dotted line and sell those products and make sure that they're comfortable and it's taking care of their needs? So we're going to be discussing all of that. I know there's several of you that are new to URL, and I would be remiss without making a formal introduction to our URL Life Markets team. First and foremost, the way to get a hold of us, you can reach us toll-free at 800-WANT-URL. That's 1-800-926-8875. You can find us on the web at urlinsgroup.com. The Vice President of our Life Markets Department and my boss is Steve Clemens. You can reach him at extension 132. My partner in crime is Joey Fry. He's at extension 157. I'm at extension 141. When you do business with us here, you have your own exclusive case manager. For agents with last names A through L, Rosemary Evans is your case manager, and she's at extension 127. And agents with last names beginning M through Z, Rachel Cook is your case manager. Our case managers will scrub the applications for you. They will assist in ordering parameds. They will also assist in ordering APSs if we need to get involved there. Basically, what their job is to help you from submit to issue. If we need to do any in-force inquiries or term proposals, they wear many hats, and they're here to help you get the business in the door and out the door and getting paid as quickly as possible. For sales support, you have myself and you have Joey Fry as sales support specialists for you. We can help you with putting together underwriting risk assessments, to running quotes and illustrations, putting together case design. If you're looking for any sales materials, we can help you. We're here to help you on the front end, to help you get that sale, help you get that client to sign on the dotted line so that we're moving forward with an application and, of course, sales for you. You can reach us on our web at unanswered.com. For those of you that are new to us here, you can use our temporary username and password. Our temporary username in lowercase letters is Gemini, and our temporary password in lowercase letters is Partners. And I would be remiss without explaining a little bit about our Gemini Partner Program. It really is a partnership on steroids. What we will be doing is offering you the best commissions available. We'll also be offering quarterly bonuses and agency contracts, lead programs. We offer free lead, free E&O, we'll also have Gemini Jaunts and also other exclusive networking events, an exclusive annual retreat, and we'll also be putting together some personalized yearly production reports so that we can set some goals together so that we're working together collectively to help you reach your sales goals. For more information regarding our Gemini program, feel free to contact me or any of us. You can also find information on our website at insgroup.com. That's the nuts and bolts of what I wanted to go through this morning. Again, I just wanted to make a brief introduction about URL, and I want to hand the controls over to Kim Grund, who is with North American Company, and she's going to be helping us over the next 5 weeks on how you can sell Index Universal Life products. She's going to be our drill sergeant for the next 5 weeks. So, Kim, thank you very much, and it's all yours.
All right. Thanks, Matt. We will get started here. All right. As Matt indicated, I'm Kim Grund from North American Company. I'm the Sales Development Specialist, dedicated marketer working with URL. URL is a long-standing partner agency with North American, and we're so glad to bring you the IUL Bootcamp series. And today we're going to start out with IUL Mechanics. And as Matt said, this is really the nuts and bolts, kind of the basics, everything you want to know about IUL. This is our disclosure page. This does pertain to the entire presentation. And so what my goal is today is I want each of you to be able to explain Index Universal Life. I want you to leave this presentation knowing the unique features of Index Universal Life that can provide a marketable advantage. I want you to have a strong knowledge of how IUL works, and then also understanding how to explain these options to agents. Although there's different parts to an Index Universal Life, really at the core, it's really simply a universal life insurance product. What it's designed to provide a death benefit just like Universal Life. And like many other Universal Life products, it has an interest rate component that can help you grow cash value. Really the difference between an IUL and another fixed UL product, an IUL can derive its growth potential from a change in an outside market index. So we're going to break down today's discussion into 3 different topics. We're going to talk about account options. We've got our fixed account. We've got our index account. We'll talk a little bit about that. We'll talk about rates. We've got cap rates, par rates, and we've also got floors. We'll also talk about the different crediting methods we have, and then the index segments, the premium buckets. So first we're going to talk about the account options. First we've got the fixed account. This is really an account option that offers a current fixed interest rate declared by the company. At North American, we've got a guaranteed minimum interest rate right now in the fixed account of 3%. We're currently paying, however, an interest rate of 4%. Our index account, this is an account where performance is going to be tied to the market index, like the S&P 500, the Dow Jones, the Euro stock. We've got a downside protected by the floor rate. The upside is going to be limited by our cap rate and our par rate. And with the index account, you've got potential for a much larger index credit than your typical fixed account. At North American, we've got a lot of index account selections. We've got over 13 index account selections. A lot of them are tied to the S&P in addition to our fixed account option. Most carriers, they're going to allow you to mix or blend your premium allocations. You can have 50% of the fixed account, 50% of the index account, or some other variation. In addition, a lot of carriers will require a certain percentage of your allocation to be held in that fixed account, and this is where they take policy charges. At North American, we don't require that. We don't require any allocation to the fixed account. If you wish, you can allocate 100% of your premium to the different index options, and you can actually split those allocations down to as low as 1% in any given account. So a lot of flexibility with North American. Also, allocations can be moved from the fixed account into any index on any business trading day when the markets are open. However, if you've got an allocation that's already in an index account, it can only be moved to another index or to the fixed account on that segment anniversary. Also, a common perception is that an index segment begins on the policy anniversary, but that's not always the case. The segment really begins when the premium allocation is received and applied to the account. So, for example, if your policy anniversary is going to be on the 15th of the month, but the premium's not received until the 18th, then that segment doesn't begin until the 18th. Also important to note, each and every new premium allocation is going to begin a new segment with a new day one to that segment. So, for example, if a client is paying premiums monthly, that client's going to have 12 index segments in that first policy year. So the first monthly segment will reach its crediting point 365 days after that first premium is received. And the next segment will reach that crediting point the following month at its 365-day point. So now we're going to go on to rates. So the interest rate growth potential for a given policy index segment is going to be tied to that outside market index. That index may not be exactly what the market segment returns. So that return is going to be impacted by three real important factors in every indexed universal life, and that's going to be the index participation rate, the index cap rate, and also the index floor rate. And we'll get into each of these three in a little bit more detail here. So what our index participation rate is, what that is a percentage of index change used to calculate that index credit. And this is going to be declared for each index segment. Now here's a hypothetical situation. It's a graph just showing the participation rate only. We're going to show a policy index of 80% participation rate. So you can see that the index differs from the actual market index performance because it's being adjusted at 80% of the change. So what's happening here is that this index is only going to participate in 80% of the increases and 80% of the decreases. So this is how a par rate is going to affect the index performance. Now there's other factors as well. What we're going to do now is just illustrate them individually, and then at the end we're going to put together a graph showing the cap, the par, and the floor rate all together so you can see how it's going to impact the performance. So our index cap rate, what that is a maximum index credit percentage. And that's going to, again, be declared for each index segment. And just so you know, some of our index selections, we don't have any cap. I'm missing a slide here. Apologize here. Well, let's see what's going on here. guess I'm missing a slide for our cap rate. I apologize. We'll see them all come together here. I'm going to go on to the floor rate. And what the floor rate is, that is a minimum interest rate that is used in the calculation of the index credit. It's going to be declared for each index segment in advance of each index period. And it's also guaranteed to be never to be less than 0. So here's our example of floor. This is assuming only a floor, no cap, no par. But in this example, you can see that the index differs from the actual market index performance because the floor is 0. That's what we always say is 0 is the hero. This is going to offset the par rates and the cap rates. The product will limit the upside potential performance, but the floor is going to protect against that negative performance in the market index. So in the years where the market index shows a loss, the floor of 0 is going to kick in, and your index performance is simply 0 rather than a negative. You see in those years where we've got a negative 22% or a negative 16%, it just really evens out. So now let's look at them all together here. So here you see all 3 factors. You see our par, our participation rate of 80%. Our cap is applied, that's 13%, and the floor of 0. So in this example, you can see that the market index, outperforms the policy index over those first couple years because the par and cap are going to limit that upside. But still, there's some good, strong growth. But then you can see enormous benefit of the floor, and that comes into play in years 3 and 4 as the policy index doesn't sustain any of those negative returns, but it still holds strong at 0% in those years. So now we're going to get on to crediting methods and buckets. So our crediting method, this is a process by which interest earned is calculated for a given index segment. So simply put, a crediting method is going to be a measurement process. So with this process, you can measure an index segment in a number of ways. And at North American, we've got 4 different crediting methods to choose from. We've got the annual point-to-point, we've got the monthly point-to-point, we've got daily averaging, and we've got the multi-indexed annual point-to-point. So we're going to start out with the annual point-to-point. And what this one does is it measures change in the index segment from day 1 to day 365. This is probably the easiest one to understand. So the process is going to start by determining a growth percentage, if any. And so you're going to do this by subtracting your starting point from your ending point, and then we're going to divide by the starting point. So once you've determined that percentage, we're going to apply the participation rate, and what that is again is a percentage of growth that the client can participate in. And then once you've determined that rate, we're going to apply the caps and the floors, which is the maximum and minimum rates that you can achieve. And then lastly, you're going to apply any interest rate bonus and multiply that rate times the beginning account value to determine your new account value. And interest rate bonus, just a little sidebar on that, our Builder IUL and our Guaranteed Builder IUL have a 0.75% guaranteed interest rate bonus on the index account in years 11 and on. We have that same interest rate bonus in year 16 and on in our Rapid Builder. So in essence, when we get to year 11 for the Builder and the Guaranteed Builder, the floor really in essence becomes that 0.75%. So that's a little bit about this calculation. So we've got an example. We've got an index account value equal to $1,500. Our beginning index account value is $10,000. In this example, we're going to use a cap of 13%. Participation rate is going to be 100%. And our floor is going to be 0%. And in this case, we've got an interest rate bonus, and that's 0.75%. So if we take these factors from the previous slide, we're going to look at these 3 examples and the outcome of each scenario. So in the first example, we had an ending index value of 2,200. So if we apply the par, the cap, the floor, and the bonus, and then we apply the ending rate to our beginning account value of $10,000, we get an ending account value of $11,375. In the second example, we're going to do the exact same thing, but we've got an ending index value of 1,600, and so we're going to apply the same factors here. And at the end, we come up with an account value of $10,742. In our last example, our ending index option value is 1,000, and so our index change here is actually negative. It's negative 33.33%. So we apply, we take that times the participation rate, which is 100. It's still the negative 33%. In this case, we apply the floor, which is 0. However, we still got that interest rate bonus of 0.75%. So our ending value, even though we didn't have any growth here, we've got that interest rate bonus. So our ending value is $10,075. So the next crediting method is our monthly point-to-point. So this process starts, we determine the growth rate, if any, and with the monthly point-to-point, this is going to be a little longer process. So you do this by, you're going to subtract again your starting point from your ending point and divide by the starting point, and that's for each of the 12 months in the segment. And then we'll apply that monthly cap in each step. So when you have all 12 of those numbers, we're going to add them all together to determine the annual growth rate. And once you've determined that percentage, we're going to apply the participation rate. Again, that's a percentage of growth that the client can participate in. And then from there, we're going to apply the caps and the floors. And then lastly, any interest rate bonus. And then multiply that rate times the beginning account value to determine your new account value. So here's our example. We're going to have a beginning index option value of 900. Again, our beginning index account value is going to be $10,000. We're going to have a monthly cap of 4%. Our participation rate is 100%. Our floor is 0. And again, we've got an interest rate bonus of 0.75%. So here you see all of the calculations for each of the months. We're going to divide those out. And so our return here is 5.68%. We change that, or we take that times the participation rate, which is 100. We're going to apply the floor, which is 0. So our ending result is the 5.68%. We're going to add that interest rate bonus of 0.75%. We're going to take that times the beginning index account value of $10,000. So our ending value with this this particular crediting method is $10,643. So here, as you see all of those monthly cap rates in that fourth column there, we just added, subtracted, and they all came up to, at the bottom line, we came up with the 5.68%. So this is the monthly point-to-point method. Daily average, much the same as the monthly, only we're doing this on a daily basis. We're going to measure the change in the index segment by using the sum return of each business day. We're going to divide it by the number of business days in the year, and no cap. So in our example here, we've got a beginning index option value of 1,500. Our annual average index option value is going to be 1,650. We're going to take the sum of each business day's value, divide by the number of business days in the year. In this example, our beginning index account value is $10,000. We don't have a cap on this. Here our participation rate's over 100. It's 102.5%. Our floor is 0, and our interest rate bonus is, again, the 0.75%. So here in our example, we've got our Average index option value is $16.50. We're going to take that, subtract the beginning index value, and then divide by the beginning index value. Index change is 10%. We're going to take that times our participation rate of 102.5%. So obviously applying the floor, we don't have a cap on this, so that's 10.25%. We add our interest rate bonus of 0.75%, so we come up with 11%. We take that times our beginning index value of $10,000, so our ending value for the daily averaging is $11,100. Another crediting method that we have that's interesting is our multi-index annual point-to-point. What we're going to do here is measure the changes in the index segment from day 1 to day 365, and we're going to use a weighted average of 3 indices. And the indices that we're using are the S&P 500, the Euro Stock 50, and the Russell 2000. And the way we're going to weight this is we're going to give 50% weight for the best performing index, 30% weight for the second best performing index, and 20% for the third, the lowest performing index. So the process starts again by determining our growth percentage, if any. So we're going to do this by subtracting the starting point from your ending point, and then we're going to divide again by the starting point for each of the 3 indexes individually. And when those 3 rates are determined, again, we're going to weight them, taking the best times 50%, second best 30%, and the last 20%. We're going to add the 3 weighted returns together to get the combined annual return. And once we've determined that percentage, we're going to apply the participation rate, and then also the caps and the floors. And then lastly, we'll apply any interest rate bonus and multiply that rate times the beginning account value to determine your new account value. So in our example here, we've got a beginning index account value of $10,000. Our participation rate is 100%. Our cap is going to be 10.5%. Our floor is 0. And again, we've got an interest rate bonus of 0.75%. If we look at our 3 options, our S&P 500 had a beginning index option value of $10.25. It had an ending option value of $12.25. The Russell 2000 had a beginning value of $9.75. It ended lower with $8.90. And the Euro Stock 50 had a beginning index option of $25.70, and it ended at $2,400. So let's see how these all play out. So the index change for the S&P 500 was 19.51%. So that's going to get our best weighting of 50%, and so that return is 9.76. Our Russell ended up with a negative index change of 8.72%. So we're going to apply that weighting of 20%, so that's going to give us a weighted return of a negative 1.74%. And then our Euro Stock, that has a negative 6.61%. We're going to apply that 30% weighting, and that'll give us a negative 1.98%. So if we sum that all up, it's 6.03% is our return. We take that times our 100% participation rate, apply our cap of 10.5%, which really doesn't come into play. We've still got the 6.03, and then with our interest rate bonus of 0.75%, we've got a return of 6.78%. We're going to take that times our beginning index account value of $10,000. So our ending value is going to be $10,678. So another nice option, because you've really got 3 indexes that you're dealing with, and obviously giving the best performing index the best weighting, and the second best is, the 20% and so forth. So, or 30% and third 20%. So what is an index segment or a bucket? An account segment that's going to hold a specified premium allocation We're going to create this each time a new premium is received, and it's got potential to earn interest on that specific premium allocation. So the duration from the premium receipt to the segment anniversary is determined by that crediting method that we talked about earlier, the different methods. So let's focus on our buckets. So in addition to the interplay of each of the factors that impact an index credit, our par, our cap, and our floor, another great feature of an index UL is our annual reset. So each index segment, or what we call a bucket, has this annual reset feature. So this means once that a bucket reaches its 1-year duration, it's going to calculate the index growth using the crediting method selected. And then we're going to apply, like we did in our examples, the participation, the cap, and the floor rates for that crediting method. And then we're going to credit the result to the account value of the IUL policy. So once the interest is put into this account, what's going to happen is it's going to reset. It's going to start that next duration. Sometimes we refer to this as a ratcheting method. What this really means is that once any growth is applied, it's then locked in. And because of the floor rate, it's guaranteed at 0. Those index gains can never go backwards. So it's just important to note that obviously policy expenses will continue to come out of the account value each year. So in a year where you have 0% gain, the account value could be negatively impacted by those expenses. Just a little bit about our minimum account value, alternate account value. We call this a true-up. Basically, we're going to calculate this using a 3% annual interest rate guarantee and current policy charges and expenses, assuming that all premiums are allocated to the fixed account. So what we're going to do is every 8 years, starting on that 8th policy anniversary, that policy account value is going to be increased to equal that minimum account value of higher. So if the policy account value already exceeds that minimum account value at the time of comparison, neither one will be adjusted. The additional account value, if any, will be allocated to the fixed account. So basically what this means, guys, is if on your index selections, if you don't at least get a 3% performance, we're going to go back every 8 years and we're going to true up that account value. If the insured dies, if the policy is surrendered, if the policy is in danger of lapsing due to insufficient premium, or if the policy reaches its maturity date, that policy account value will at least be as large as that minimum account value. So and once we get into illustrations, if you're looking at that guaranteed column of the illustration, that does show the true-up. Like I said, every 8 years, if that policy is not at least getting that 3% performance on average, we will true it up. The minimum account value is not available, however, for the calculation of the maximum available for, say, the variable interest rate loans or partial withdrawals. So just to summarize, we went over the different account options. We've got our fixed accounts. We've got the different index accounts. We went over the rates, the caps, the pars, the floors. We went over the different crediting methods, the annual point-to-point, the monthly point-to-point, the daily averaging. We talked about those separate premium buckets, annual reset. So showed you a lot of the basics of Index Universal Life. Bottom line for the clients, at North American, we've got great flexible products to meet their needs. We've got different options for cash accumulations, and we'll get into more of products that can meet their needs in these next IUL bootcamp presentations. And for you as an agent, an understanding of the product mechanics, how IUL works. At North American, we've got great resources that can provide marketable advantages. We've got great marketing pieces on how an IUL works and the various sales concepts. We've got over 13 different sales concepts with all of the marketing materials, videos, postcards. As a contracted agent, we've got postcards on many sales concepts that you can actually send to your clients. We'll customize these free of charge if you're a contracted agent with North American. All you have to do is put the postage and the mailing labels on them. So we've got a lot of resources here at North American. We've also got a microsite that has all of the sales concepts available to you in video and PDF format. We've also got recorded videos, tools for social media as to ways you can market to your clients. So just a lot of resources here at North American. So next steps, get a hold of Joey and Matt and everyone at URL. Familiarize yourself with North American's IUL. Identify and contact 5 clients. Look at your book of business and see if you've got clients that might be interested in this upside potential of Index Universal Life. And at North American, we want to be your IUL carrier of choice. We've got a lot of solutions to meet your clients' needs. And that pretty much concludes our session. Matt, do we have any questions from anyone?
We have a lot of questions, and we're going to get into that here in 1 second. Folks, we're just cracking the surface on Index Universal Life sales. This is just the beginning. So we have coming up next week at this time, we will be discussing index credits and how insurance companies do the index credits. So that'll be week number 2. So stay tuned for that. If you do have questions after this presentation today, feel free to contact us here at URL. You can reach us at 800-926-8875. My extension is 141. You can also contact Joey Fry at extension 157 and Steve Clemens at extension 132. So we do have some questions. We're going to get into that